Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. Have a lot to cover with you guys. I hope that you guys all had a relaxing and wonderful July 4th weekend. We have quite a bit to get through today because we were off last week. And markets are in a very different position than we were in some ways, and in other ways, very similar to where we left off. So quite a bit to cover here today. Let's go ahead and get started. Now, before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration and educational purposes. It is not a recommendation or solicitation to buy or sell any specific securities. Now, just a reminder for those of you that are trading on your mobile phone, Firstrade recently just launched a new mobile platform, giving you the ability to trade with a redesigned options chain. It has brand new functionality to allow you to easily enter complex orders and allowing you to close your complex positions from your mobile platform. Great. I've used it myself. It's really easy for you to edit positions, edit your orders. This is all available in the new iOS mobile platform. So if you're trading options, especially on the go, please check out Firstrade's new iOS and Android platform for options trading. So today we have a lot to get through, but first we'll start off by just a quick market update where we currently stand with the major markets, where we are seeing underperformance, where we are seeing outperformance, because that is very important to help us answer as far as where markets are headed next. We'll take a look at some of the COVID-19 trends because market price action has been dominated by some of these news as far as the recent spike in cases. So we want to revisit where are we seeing some trends, what trends are they, and what can we expect? Are we going to see a second wave? What does that actually mean? So those are some things we're going to explore. Then we'll take a look at the earnings calendar because earnings really kick off in full gear next week. So we want to make sure that everyone is familiar and aware of what's coming down the pipeline, what to pay attention to, especially symbols that you might have in your portfolio or symbols that you might want to trade yourself, and then look at some of the trade ideas we have. And at the end, if we have a few minutes, we'll open this up for Q&A. But the primary question I want to help investors answer for today's session is the question that I've been getting a lot over the past few days and the past few weeks, really, and the question is really, can markets continue to break out higher from here? So we want to take a look at the markets to help you answer that. My name is Tony Zhang. I'm the chief strategist here at Options Play. Let's go ahead and get started with looking at some charts. So we'll start by taking a look at the S&P 500. And one of the things that I wanted to point out, or I did point out last week, was that 318, 317 was a major resistance level, which we tested yesterday. And what's interesting about yesterday's price action was that we opened up at 317. It traded all the way down to around 315, 314 or so, and then rallied back up to 317 on the close. Now, the reason 317 is such an important level is because you have this, what we would normally call this kind of island top. This is usually the type of formation that you see at market tops. These are usually the types of formations that you see kind of an exhaustion gap higher, and then markets fail at that level. And it's interesting that the markets reached that level and could not break out any higher yesterday. And this is telling to us that 317 is a major resistance level. For the past few weeks, we've been saying that we expect markets to be somewhat neutral between 317 and 300. And as of right now, that is still our base case, especially after yesterday's price action, where markets could not break out above 317. If it does break out above 317, then that puts us in a position where markets could potentially revisit that 339 high back in February. So we want to take a look at the other markets to help us answer the question as to whether S&P can break out higher and continue to move higher. So for that, we're going to take a look at some of the other markets. But technology, NASDAQ 100 index continues to lead this market higher. We're continuing to see this leadership in the markets narrow. It's narrowing predominantly within technology and some of the discretionary names that is leading this charge higher. Predominantly the FANG names are leading this market higher. And that is concerning because during the initial rally from the March lows all the way up into April and May, the leadership of the market rally was pretty broad. We saw all the sectors participating. We saw equal weight participating. We saw small caps participating, but that has started to narrow, and this is a concern to us. However, just keep in mind that because you have leadership narrowing, leadership can narrow and continue to narrow for a long time. So that in itself is not a good reason to go out there and short the markets or say that the rally is over. It's just something to be aware of as you look at the markets. One of the things I want to point out is as tech continues to move higher, momentum has not confirmed those moves higher, which leads us to a higher probability of a quick pullback here. It doesn't have to be a big pullback back into the 250, 245 range. I would imagine that the Qs are going to open up a little lower here today, but these are some of the things that we are concerned about in the current market, is that the names that are leading us are starting to see signs of exhaustion, starting to see signs of negative divergence, which increases the probability of a short-term pullback. So our base case, again, is that the S&P 500 stays within that 300, 317 range. If it can break out, then we are off to the races for substantially higher names, substantially higher levels in the S&P, while NASDAQ 100 we expect to still continue to lead this market. Now, some of the concerns that we continue to see is that small caps have not continued to move higher as markets rallied over the past few days. Small caps has really stayed within this really tight range here. And the question is whether small caps are going to break down to the downside. If small caps break down to the downside, that would not be particularly good for the rally. If small caps can break out to the upside, that is where there is more support for the markets to continue rallying higher. Same thing in the equal weight index. Equal weight index has not really rallied much over the past few weeks as the markets continue to consolidate and move higher. Equal weight still stuck in this 100, 103 range, 104 range. If we can get a breakout higher, that certainly, again, would be supportive of this market continuing higher. We will take a look at some of the sectors. We won't take a look at all of the sectors. Maybe I'll take some time on Friday to refocus on all the sectors and show you where each sector stands. But I will highlight some of the sectors that are of interest to look at here for today. Now, the question then becomes, where do we see performance? And looking at emerging markets, we've really seen emerging markets start to come to life over the past couple of trading sessions. We've been talking about emerging markets for a while, but it really has been consolidating for some time after breaking out from that $38 level for quite some time inside this wedge, if you will, and recently just broke out to the upside. So emerging markets, this particular ETF, EEM, is heavily weighted towards China. So we are seeing outperformance here. You know, Chinese markets were up about 5% yesterday. That provided a pretty big bump here for EEM over the last couple of trading sessions. But this breakout here, I would look for some kind of consolidation today back into this 41, 42 area and look for a continuation higher. These are the types of markets where we do see significant outperformance that where valuations do not look as stretched, and there are, in my opinion, not only based on technicals, but also more of a fundamental reason for a rally here in some of these emerging market names. And I will take a look at a specific country here in the trade ideas section that has a interesting technical setup for a breakout here. If we look at the VIX still remains very elevated, but below the $30 level here for VIX. So VIX has been moving slowly or grinding slowly lower here over the past couple of weeks. It is now below 30, but that still remains fairly elevated compared to what we considered normal back in January, February, and end of 2019. So we're still looking at levels that are almost triple where we were trading back in January and February, but because it's elevated but relatively stable, this leads us to the strategies that we're trading. So when we're looking at option strategies at the moment, we're focusing more so on the option selling strategies, option premium generating strategies, whether you're selling covered calls, cash secured puts, selling credit spreads. As markets remain fairly neutral, credit spreads have been an ideal strategy to utilize unless they start to break out to the upside. If markets start to break out to the upside, we would expect VIX to continue moving lower. That would make credit spreads less attractive and start looking at buying options like calls and call spreads. So this is the option strategy. This is how you want to position yourself here for the current market conditions. As long as markets remain neutral, selling credit spreads as will be profitable as markets continue to stay put, and the higher volatility means that you're going to generate more premium. As market starts to break out, volatility will start to contract, and that's when it becomes more attractive to start buying those calls and start playing those breakouts, especially as we go into earnings season. Crude has remained fairly muted here over the past few weeks as crude continues to trade sideways here between this $35–40 level here and has not really moved much higher while momentum continues to move lower. So at this point, we've been talking about this $41 level as resistance for quite some time, or quite a few weeks now, and it continues to act as resistance, and momentum is actually continuing to move lower as oil kind of continues to grind higher above towards this $41 level. So this is, from a probability-based perspective, likely to see more of a move to the downside here for oil, especially as demand drops globally. But there are some fundamental factors that could lead to a potential breakout. So the breakout here, you do have a level around $50, $51 that is a good target to the upside. But again, I think the probabilities favor a decline here in terms of oil prices as it fails to break above that $41 level. But we are at a pretty pivotal moment here in terms of oil. It is at this breaking point, if you will, almost, or apex of a triangle, and the question is, which way is it going to break? Energy has predominantly been lagging the markets over the past few trading sessions in the last couple of weeks. So this is something to really pay attention to, because we're likely going to see some decent size moves here in XLE and some of the energy names as we approach this triangle here for oil. Gold continues to break out higher, and this speaks, I think, more so to investors' concern about inflation in terms of the dollar, as gold continues to slowly grind higher. Gold breaking out has not caused any big moves to the upside. It is really a much slower grind. So strategies where, generally speaking, when they reach support levels like this 164, selling credit spreads, put credit spreads slowly as it starts to grind its way higher, using the 20-day moving average as entry points, have been a good strategy. So this is something that we continue to see every time it pulls back to that 20-week moving average, looking at selling put credit spreads. Gold implied volatility relatively high at the moment, considering the fact that gold is at near all-time highs, meaning you're able to collect a higher premium by selling strategies like put credit spreads here on GLD. So those are some of the markets we're paying attention to and taking a look at, but I do want to point us to some of the COVID-19 trends that are of interest, because there are a lot of questions from users saying, how can markets continue to be trading at relative highs given the fact that we continue to see a significant spike in COVID-19 cases here in the United States? So I want to point us to two charts that I think is part of the optimism that markets have that may sometimes be a little counterintuitive. So first of all, one of the things that we want to point you to is the comfort level that consumers have with doing certain activities during the recent spike that we've had in COVID-19. And we've seen a decline across the whole board with basically anything related with going out. Now, generally speaking, we would consider this decline in confidence as a bad thing for the markets, because if consumers are not out there spending money, that's going to be a bad thing. However, I would like to create a bit of a counterpoint to that, is that if Americans are are more cautious, and they are less comfortable doing some of these things. That gives this country a greater chance of flattening the curve and not seeing a resurgence in spikes or a second wave as strongly as maybe some of the other countries have. Now, some people would argue that we are currently in the second wave, but most of the states that have seen the significant growth in cases were states that never really saw a first spike to begin with. So I think markets are being optimistic here that consumers or Americans are being somewhat cautious and doing their part in preventing a second wave, if you will, and couple that with the fact that the number of deaths have continued to decline as the number of cases have increased. Now, there is a lag here because there is the possibility that the growth in number of cases that we're currently seeing now might start to see an increase in deaths, but that has not materialized yet. So the number of deaths have continued to move lower, and that is part of why I think markets are continuing to trade near all-time highs despite the headlines that we're currently seeing in the markets. And one thing I will point us to is some of the open table metrics for COVID-19 across the world. And what's interesting is that you have plenty of countries like Canada and the US that are starting to see an increase. You have countries like Germany that are back to almost 100% normal. And then you have countries like Australia, which originally had very few cases and returned back to normal very quickly, and now has seen a new resurgence in terms of cases, and now restaurants have started to close back down again, and we've seen a significant decline. So what I think the United States have done is really avoided this really quick reopening and then seen this huge number of spikes again. Now, some people would argue that we have done that, but most states have not reopened restaurants, certainly not indoor dining, which Australia did open. So this is something that we are watching very closely, because as we go forward, we're learning that most of the recent spikes in cases have been caused by states that have reopened indoor dining. A lot of this is associated with gatherings in indoor places. So places that have reopened for outdoor dining have not seen this resurgence in spikes, and especially such as New York State. And these are some of the lessons that we're currently learning from these other places. And I think that while things look pretty bad here in the US, especially if you look at the number of cases that are happening, but the trend, it continues to trend lower, not just here in the US, but globally. If you look at Russia, if you look at Brazil, you look at India, these are some of the heaviestly impacted places around the world at the moment. These are all places that have started to see a decline. And again, that's part of why we're seeing the markets continue to trade at relative highs, as well as emerging markets continue to move higher here. So, the earnings calendar. This is an important thing to keep an eye out for, because next week on the 13th is when we kick off the first mega cap, very liquid names in terms of earnings. Pepsi, Citigroup, JP Morgan, United Airlines Monday, Tuesday, Wells Fargo. And then you start getting into some of the bigger banks like Goldman Sachs, US Bancorp, PNC. And then you start getting to some of a few pharmaceutical names like ABT, Johnson & Johnson. You have some more banks, but you also have airlines. You have United Airlines, you have Delta, you have Microsoft, you have Netflix. So you have some very interesting names to pay attention to. And keep in mind, this is Q2. This is the full quarter of COVID-19. Q1 earnings really was just a few weeks of COVID-19. Now we're getting a full quarter. So this is really where we're getting the full picture of the extent of the impact that COVID-19 has had on these companies. And we can use that to project out to some of the other companies that are going to be reporting later in the season. So very important to pay attention to in the first week or two. So very, very important to keep an eye out for this calendar. So I want to point out to some of the names here that we're paying attention to. So first of all, we want to take a look at the financials, and specifically looking at American Express. Now, the financials have started to bottom out a little, and the relative underperformance that we've seen in financials have started to slow down. meaning we're no longer continuing to see XLF underperform the markets. We're actually potentially starting to see that turn around. So we wanted to take a look at some of the names that were bottoming out here, such as American Express. And I want to point us to American Express because American Express have responded fairly well to this $95 level over the past few months as resistance, but recently more so as support, and has pulled back significantly from that all-time high, a relative all-time high, back to this $95 level, and now has the potential of moving higher. Now, the potential here isn't particularly strong, so that's why, again, for these types of strategies, our preference is to sell premium, sell put spreads here around this $95 level, so that if you get more of a slow move to the upside or a slow grind, you're still able to take profit on this particular trade, rather than if you bought calls, you really need that quick move to the upside in order for this strategy to be profitable. So American Express is one of the financials we're paying attention to. There are lots of other names, but like Goldman Sachs, JPM, but those are reporting earnings next week. So if you want to play those as an earnings play, you can do that, but understand that there are higher risks with those types of strategies. I wanted to take a look at Brazil. We talked about emerging markets being strong, but Brazil was something that we brought up a couple of weeks ago when it started to break out above this $28 level. It has now revisited that $28 level, very similar setup to American Express, but a little bit, I would say, you have a little bit more confidence in that $28 level holding because you've held it for quite a few, for almost a week now. So this gives me more confidence in EWZ, which is the Brazil ETF, will continue to move higher here from this $30 level, initially up to this $35 level as your initial targets, and then potentially higher to the upside in that $41 level if you can move higher over the next couple of months as Brazil continues to decline in terms of number of new cases, which is probably the worst place that we've seen in the world right now in terms of COVID-19. So we're starting to turn around that, flatten the curve, and we're starting to see that reflect in the equity markets as well. I want to take a look at XLC and communications sector. So today, like I said, we're not going to spend enough time to go through all the sectors, but I did want to pay attention to some of the sectors that have interesting outperformance. Communications, clear outperformance. What's interesting about communications and why I want to take a look at communications is because we've had this recent consolidation period after a very strong and consistent move to the upside. And communications is just starting to break out to the upside. So this is really where we can see some big moves to the upside. So you have telecom companies, you have Netflix, Disney. These are all types of names that are in this particular sector. This is a pretty broad sector, but a lot of the streaming names, a lot of the telecom names, these are the names that we think are going to continue to outperform post-COVID-19, because as we look at companies and how they think that they're going to be conducting work, everything from cybersecurity to network communications to streaming stocks, these are the stocks that are going to outperform going forward, and they are all within the sector. So if you don't want to pick individual names, you can look at the overall sector, but there are some interesting names within the sector to keep an eye out and pay attention to. XOM. So we talked a little bit about oil and how oil has struggled to break above that $41 level, especially as oil continues to move higher, momentum is continuing to decline. This leads us to believe that oil could see a move to the downside here. So names like Exxon, names like Chevron, Phillips 66, big names within the XLE sector are the names that we're paying attention to. And notice how Exxon over the past few weeks have really continue to move. So we had this major triangle here where Exxon broke out to the upside and then went back into the triangle, is now broken to the downside of this triangle. So this, from our perspective, from a chart setup perspective, does not look particularly strong and likely might see some continued underperformance back down to that $40 level here, especially if you look at the weekly chart. The weekly chart continues to look extremely weak, got rejected at the 20-week moving average, and is likely going to continue moving lower. Now, for this, again, I wouldn't go out there and necessarily buy puts, because this is really where the volatility still remains relatively high here for XLE. I also am not confident that you're going to see a big move to the downside that would warrant buying puts, that I believe you're better off selling call credit spreads so that you are able to collect premium when the volatility remains high and implied volatility remains high during this time period to trade these types of names. So these are the types of strategies that we're paying attention to, and the names in the markets that we're paying attention to here in the markets. And lastly, I want to leave you with consumer staples. Consumer staples, something that we pay attention to, but as you can see over the past few months, have really continued to just stay sideways between this $57 and $61 level. But the thing to remember here about consumer staples is not just that the markets have, just that consumer staples have moved sideways here, but more importantly, because as staples move sideways while the markets move higher, this is continuing to underperform. So when you're looking at names, if you're looking for some shorting opportunities, look for names here in the consumer staples sector, because this is a sector that continues to lag the markets. Whether you're looking at some of the food staples like Campbell's Soup, General Mills, these are the types of names that you might want to focus on. Kraft Heinz. These are the names that are going to continue to underperform the markets. And if you're looking for opportunities to sell call credit spreads that on stocks that you don't think are going to continue to rally, focus more on the sectors such as in the consumer staples space that have underperformed the markets and have are likely going to continue to underperform going forward, especially in the light of communications, healthcare, and technology leading this market higher, and discretionary. Look at Amazon. Amazon's now above 3,000. So discretionary leaving this charge higher, predominantly in some very few names. This, again, is concerning for consumer staples. So if you're looking for short opportunities, that's where I would look. And lastly, we have just a couple of minutes to answer some questions here. One question is, how do you access the spreadsheet that shows the liquidity of companies? I will post a link here into the chat window for those of you that want to access the earnings calendar on how to go about doing that in the link. Warren getting involved in Dominion, what do you think? I don't know anything about Dominion. If you're talking about Dominion Energy, I simply don't know anything about this. The chart doesn't look particularly strong. If you look at the weekly chart, this really looks like, to me, a bit of a head and shoulders formation. It looks like it just kind of broke below this neckline here and could be headed lower down to 67.5. If we look at the chart here, that also doesn't look particularly strong, this breakdown. But the fact that it's down, 11% yesterday, there was obviously some news. I'm not privy of what that news was, so I don't think I want to comment here. Will you go long Zoom? So I think Zoom at this point is what I would consider fairly priced. It's clearly overpriced by most metrics, but because of the growth factor, it is what I would consider fairly priced. I do think that you do have an elevated chance of Zoom pulling back here, especially in the short run. So with that, I want to thank everyone for taking the time out here this morning. I hope that you guys find this useful in helping you guys set up your day and better understanding where you should pay attention to. So thank you so much. I hope you guys have a great day, and I'll see you guys here next week.